So, how does an investor potentially protect themselves now?
Well, the way to think about it is obviously focusing on long-term investing. If an investor is looking at things to be concerned about, I'm not sure a government shutdown should be number one on that list. I think we're just beginning a new round of interest rate cuts, and so that's something that's really been more impactful on the market. We're starting Q3 earnings season in 3 weeks' time, so corporate earnings and the overall strength of the companies that make up the market, that's going to be far more impactful, we would argue. And then, of course, we continue to be in a world of tariffs and a kind of moving targets around tariffs, so that's going to be pretty important. Government shutdown, again, it's on the list. It's something that makes people kind of not feel great about the situation. It's, you could argue, embarrassing, but it's not necessarily going to be driving the market. I would also point to the longest government shutdown that we had, which was during the first Trump administration, late 2018 into 2019. It lasted over a month. And the market, for other reasons, was up 10%. The S&P 500 was up over 10% over that period of time. And that was driven a lot more by Federal Reserve policy than it was the lights being turned out in Washington for a month.
So, are your clients asking questions about this? And how do you advise a client who would ask a question about this?
We get a lot of client anxiety during periods like this. We're based in the DC metro area. The year started with Doge. We had tariffs later on. Now we're heading towards yet another uh, showdown between parties over actually keeping the government open. So that creates a lot of anxiety. What we try to do is we try to orient clients' concerns towards the things within our control. Uh, Interest rates are starting to move down a little bit, so the bonds prices are starting to move up. So that part of the portfolio is starting to do better and create a lot of income for clients. The main thing that we preach is being tight to your target, meaning if you're at 60% stocks, 40% bonds, you've let those run, the stocks have run to 70%. It's a good opportunity not to get out of stocks, but to be disciplined and rebalance back to 60%. Stocks have done great. Let's book some profits, and bonds are still attractive. So that's kind of we focus on those things that we can control as opposed to things that are outside our control.
How do you or your colleagues, react to when government, the inability of either side to compromise? Is it even an issue, or is Washington looked down upon by people who, have to lead lives and help others make investment choices?
I think that the markets have a pretty healthy cynicism about how Washington does business. If you actually look at negotiations in the past, both sides like to leave it till the very last minute to see if the other guy will blink first. We think about the debt ceiling discussions of early 2023. The White House wouldn't even meet with the new Speaker of the House until the House had passed the budget. This is kind of the gamesmanship that goes on. We saw really entrenched positions from Senate Democrats versus what we're hearing out of the White House. There's a lot of very uncompromising talk and aspersions being cast. But I think it's just noise. And I think at the end of the day, they're watching polls like everybody else. The governing party right now is the GOP. They were kind of blamed for the last two major shutdowns, 2013 and 2018 to 19. And so they might be looking at those polls a lot more carefully than they might be letting on.
You willing to just go out on a limb? You think they'll reach compromise before the October 1st deadline, or do you think it'll be soon after?
It's very hard to handicap. In terms of going out on a limb, I would argue that a long shutdown is probably unlikely. But if we do go into a shutdown, it could be hours or a couple of days. We've had several that were just one day long. So in the game of chicken, no one moved out of the way in time, but then a day later they got something done. So a short shutdown is more likely, I would argue, than a long shutdown. And no shutdown at all is still possible. You could see people soften their positions as we get to the end of the month pretty quickly.
And did I understand correctly, though? Really, impact on investors on 401ks is negligible.
Negligible. I think there's a lot of much more important factors out there that are going to drive things, and the Federal Reserve is in the driver's seat when it comes to the market, rather than the White House and the Senate Democrats. I think there's other things to be concerned about when you look at the stock market right now. Government shutdowns may be in my top five, but it's not at the top of the list. I would add that dysfunction and brinksmanship in DC, the market's kind of becoming immune to it. It's really been, since the April sell-off, it's been a pretty smooth glide path upwards in terms of the market. We're up over 30% since those lows of April. And yet, when you look at newspaper headlines, everything feels like a crisis. So this shutdown, just throw it onto the list of crazy things that we've been reading all year long, but the markets seem to just shrug it off. And we might see a modest pullback of like 1% or something, but I don't think we're going to see a major correction based on a shutdown if it does occur.